Thanks for watching. Today I'm speaking with Hamish Douglass, our Chief Executive and Lead Portfolio Manager on our global equity strategies. We recently undertook a roadshow across Australia where a large focus was particularly on technology, disruption on potential markets and industries. But today we're specifically focusing on the portfolio positioning. Hamish, we've got feedback from advisors wanting a little bit more insight into the portfolio. Is it just a tech fund?
Well, Frank, of course it's not just a tech fund. We have around 35% of the portfolio in technology stocks, and that weighting has increased over the last 18 months or so, as we've seen some really interesting opportunities in that space. But that means we've got 65% of the portfolio that's not in technology companies. Actually, we've got 15% in cash, so 50% of the portfolio is in equities that aren't technology. We've got payments franchises, Visa card and MasterCard and PayPal. We've also got over 10% of the portfolio in some large healthcare stocks. We've got a number of large retailers, Lowe's, Target, Tesco and Woolworths in the portfolio. As you can see, it's playing on many different themes, but even within technology, if you split it down where we're invested in technology, it's quite diversified. And I would say in our technology, we're in 4 different areas. We're in consumer services platforms. And in that, I would probably put our positions in Apple and Alphabet. We're in enterprise software businesses, leading to productivity through software for large enterprises in the world. We would put Microsoft in this, we'd put Oracle in this, and we'd put IBM in that area. We've got positions in semiconductors, making chips to power computers and mobile phones. We've got an investment in Intel and Qualcomm, and we've got an e-commerce play through eBay. So you can see our tech, even though we're in technology, you can't simply put a blanket over called technology. We're actually playing in very different areas of the technology space. And so if we've got 4 areas of technology and then we got 65% of the portfolio that's not in technology, we're actually very well diversified within our portfolio, notwithstanding the increased focus we've had to certain technology companies over the last 18 months.
And so how do you see the valuations related to the technology companies within the portfolio?
Well, we're value investors at the end of the day, and we're very clear about the returns that we want to generate for our investors over time. So we don't invest on some thematic basis that has no relationship to valuation. If you look at the 8 technology companies we've got in the portfolio at the moment, based on our estimates of earnings, they're trading on a 1-year price to earnings ratio of slightly over 16 times. That's in line with the multiple of the world markets and actually at a discount to the S&P 500. And I can tell you these companies have far better prospects than the world markets and the S&P 500, and in aggregate we're paying a multiple no higher at a discount to those markets. So this isn't like the year 2000 where we're paying multiples of sales with no earnings or 50 times earnings. We're paying a multiple on average for our technology exposure of 16 times next year's earnings, and I really don't regard that as expensive.
So Hamish, talk about one of the tech companies that seems to be towards the higher end of the multiples. Alphabet looks like it's around 25 times earnings.
Yeah, you're right. The headline multiple for Alphabet is around 25 times earnings, but still we regard this as very good value for a business like Alphabet. First of all, you have to understand that if you strip out parts of their business that are losing money, called their other bets, like their investment in fibre and driverless cars and other areas, they're spending over $4 billion a year on effectively research and development in trying to develop some very, very big projects. If we strip that out and call that another business, and then we take their cash and we adjust their market capitalisation for their cash, which is nearly $80 billion on a net basis at the moment, and we could even take off the repatriation tax on that, and then look at the multiple we're paying for the core business of Alphabet, we're paying around 18 times next year's earnings. So we're paying a slight premium to the market for businesses like Google Search. And then we've got huge optionality beyond that. We've got Google Maps, which they're starting to monetize. We've got YouTube that's got an enormous runway in terms of monetization. We've got the Google Cloud platform that competes with AWS, which is the Amazon cloud business, and also Microsoft, which is in very, very early innings. But all those businesses in aggregate, which is really driven predominantly by search and YouTube at the moment, in their last quarter, they grew their revenues by 25%. And we're paying 18 times earnings for a business that's currently growing at 25% per year in probably almost the most strategically advantaged company on the planet. We don't regard in any way, even though it's the most expensive technology company, just looking at a headline multiple basis we own, even that we regard as fundamentally cheap at the moment.
Hamish, there's a lot of talk around the US elections, and in particular whether Trump might get up. What's your take on that?
Yeah, at the end of the day, you have to start with, we don't know what's going to happen in the US election, and be very careful of opinion polls. Just like we said pre-Brexit, we didn't know what was going to happen. The probabilities are slightly in favour of Clinton at the moment, but that still means there's a very material probability it could be Trump. So you have to think in your mindset is what happens if Trump was elected and how it could affect your portfolio. Absolutely, volatility in markets would most likely go up. We're not that nervous about volatility, and the US dollar, because of some of his trade policies, could be quite volatile, but it kind of balances out for the US dollar because we've got a lot of multinationals. A weakening US dollar would be very beneficial for many of those multinational businesses, yet the translation, if you're thinking an Australian investor, would get hit on the translation. So we're somewhat neutral on that. There are a few businesses who could be hit if there was a real trade war with China or something. Apple, for instance, if they weren't allowed to manufacture or something in China, which Trump has sort of hinted at, but I think that's quite far-fetched. But we're not that exposed to sort of that trade war issue in the way that our businesses operate. And actually, there's probably a higher probability with Trump that we would get some form of tax reform, particularly on offshore cash that's held. It's actually quite bipartisan, that issue, and that is one of Trump's platforms. And actually, our technology companies have enormous amounts of offshore cash that we're assuming they pay the full 35% tax rate on. If there's any sort of headway on that issue, and Trump's probably the more likely part to make headway on that, although Clinton's supportive of that as well, that could be very beneficial that we're not factoring in. So don't necessarily assume an election of Trump is necessarily bad for our portfolio, even though we're probably going to see some more volatility. And Clinton, it's probably more of the same in reality in terms of the economic scenario we're looking for. So in terms of Trump getting in, it's probably not the number one issue on my agenda.
So given that Trump isn't weighing on your mind, the portfolio, as you mentioned, still holding 15% cash. So what are the macro issues that matter to you right now?
Yeah, I'd probably put them in three in order. I think the number one macro issue in the world is monetary policy and what the central banks are doing. We've got a massively distorted fixed income market that's actually distorting all asset pricing in the world. So if there was an unwinding of some of this monetary policy with a tightening led out of the United States, it absolutely could impact asset pricing in the world. So we remain cautious on that, and we're in unknown waters, and we know we're in a world that is hugely distorted by actions that the central banks have been taking. No one has a perfect crystal ball of how this is going to be playing out, but to not be cautious that we could have some real speed bumps around global monetary policy, we think is the biggest elephant in the room. The second issue is what's going on in Europe, and this is going to be playing out for the next few years. We have a referendum. We've already had Brexit, as we know, in the UK. Now we've got an extended period of uncertainty in the UK. We've got a referendum in Italy at the end of the year, which could turn into an election issue the following year, and particularly for the current government, which could give more power and more popular things to some far-right movements. We've got elections next year in France, which will be critically important, and in the Netherlands. We've got parties rising up almost on a Trumpism basis about global trade, about immigration and other issues. And if we saw more sort of Brexit movements in Frexits or Nexits or whatever you want to call them, if they got momentum in an election cycle in Europe, that could actually be quite destabilising. And then another issue in Italy is the banking system in Italy. And we're doing a lot of work and spending a lot of time thinking about how large a systemic issue that is in Italy at the moment. So that whole European complex is something that's going to be playing out over the next 18 months or so, and we're watching very carefully. And the third order issue I'd put is China. I think everybody knows the issues in the Chinese financial system. We know there's a lot of bad debts. We know there's been a massive credit boom in that country. Our baseline thesis is that the Chinese government will deal with this by kicking the can down the road over many, many years, but there is unlikely to be a financial crisis. But it could be it takes a turn for the worse, and if there was a financial crisis in China, that would fundamentally affect the world economies and would be a big event. We're not putting that as our central case, and it's a lower order issue for us, but that's another issue that we have to get our minds around. But remember, we're 15% in cash and we're running a very high quality portfolio, and actually we're overweight technology growth and things, and most of these businesses are going to keep penetrating deeper and deeper irrespective of what's going on in Europe or China or monetary policy. We could get more volatility. Volatility in markets is kind of the friend of what we do at the end of the day, particularly when you're sitting with the cash balance that we have at the moment. But we're cautious. We're cautious at the moment, but comfortable with the portfolio we have.
Thanks, Hamish.
A pleasure, Frank.
And thanks for watching, and feel free to forward this link on to clients that you think might also be interested. Thank you.